Hey Bowtie Nation, Joseph Hogue here with what could be the best kept secret in the stock market this year. Something nobody is talking about, but is already beating the market and could run much higher. Stocks in the real estate sector are beating the market by more than 6% this year, the third best performing sector, and saving your portfolio from the crash. It could be the start of an historic rebound, with the group up just 27% over the past 5 years, the worst performing of the 11 stock sectors. The Fed raising interest rates at the fastest pace in 4 decades, and the office property implosion destroyed real estate stocks in 2022, crashing 26% on the year. But just as that rebound from the 2008 crash saw these stocks up 200% in the following 6 years, we could be now seeing a new renaissance in real estate returns. Stubbornly higher interest rates have kept the sector from its real rebound over the past 2 years, but now Fed cuts this year could unlock that value. I'm going to show you which property types could outperform and how to find all the information you need on real estate investment trusts. Then reveal those 5 stocks I'm buying for this new era. First off, within real estate, you have got to start by looking at it by the property types, because how each one reacts to the economy is so different. It's like the difference between tech stocks and utilities. Sure, they're both stocks, but the companies are wildly different and are going to perform or outperform in different markets. Here we see the 13 property types, and I'll show you how to find this data later, but first, we're going to pick our 5 of the best property types for this market, then drill down into each of the best stocks. Now, over the past few years, industrial has been the way to go with the rise of e-commerce and the need for that warehouse space. But tariffs right now have got that group in chaos, and here I wouldn't touch office just yet. Retail property demand could weaken with consumer spending, and there was a huge amount of apartment building over the last few years, so I'm not sure if residential is the way to go either. Healthcare, though, has been the surprise winner this year and last, with the hospital operations on the rebound. Self-storage will always see solid demand because we love to buy more chit than we can fit in our garage, and telecom should do well with the rise of AI and data connectivity. That also includes the data centers here, which have given back quite a bit this year, but are coming into value territory. And gaming, while it will get hit on a consumer slowdown, is also a property type with strong long-term tailwinds. I'm going to reveal those 5 real estate stocks I'm buying next, but some of the best returns from this rebound in real estate could be buying property directly. That's where today's sponsor, Baselane, comes in with its all-in-one rental banking platform built specifically for landlords and property investors. If you want to level up your rental business, automate the admin work, and just scale like a pro, you definitely want to listen to this. With Baselane, you can open an account in minutes and organize your rental finances through unlimited virtual accounts and smart automation. No monthly fees, no minimums, just seamless tools to manage everything from one place. AI-powered bookkeeping automatically categorizes your expenses, keeping you tax-ready with a click of a button. You'll also get real-time cash flow tracking and easy-to-read analytics, so you always know where your money's going. Baselane also puts rent collection on autopilot, automating reminders, late fees, and rent payments across all your units. Tenants can pay from any device, and you get paid on time every time without lifting a finger. As someone with property myself, I can definitely see how this could supercharge your rental business. So whether you've got one property or a growing empire, Baselane helps you scale faster with intuitive tools that cut out the busy work and save you hours each month. Let Baselane handle the admin so you can focus on growing your real estate business. Head over to www.baselane.com/Joseph to sign up for Baselane for free and get a $100 cash bonus when you fund your account. Or just look for the link I'll leave in the video description below. Our first real estate stock is in a long overdue theme with healthcare REITs and global medical REIT, ticker GMRE, with its solid 10.7% dividend yield. I'm going to detail why I'm going with GMRE next, but you could also go with Medical Properties Trust, ticker MPW, here with its 6% yield, and a stock that is finally seeing some life. Now, GMRE is one of the smaller REITs in the space at just over $1 billion market cap, but more focused on hospital patient services and clinics with 185 buildings and 4.8 million square feet. Besides that hit to all real estate from surging interest rates, hospital and healthcare operations have been slammed over the past few years on lower insurance reimbursements and medical staff shortages after the pandemic. That led to hospital bankruptcies and closures across the country, flowing down to missed rents for these real estate companies that own the properties. But that's turning around now with higher reimbursements for the procedures and a slightly better staffing environment. FFO growth for the healthcare group is forecasted up 16% from this year to next, one of the highest rates of cash flow growth in real estate. I've held on to shares of MPW for its dividend and like the stock on its rebound potential, but it's still very highly indebted at 51 times debt to EBITDA, while GMRE is much safer at just 7 times debt ratio. And GMRE is forecast to see FFO fall this year, but I think it surpasses on the upside for positive growth. In the self-storage property type, I'm going with the industry leader, Public Storage, ticker PSA, and while at 4%, it's one of the lower dividend yields in the group. This is a property type with very high margins and strong stock returns, The share is up 1,200% in the past 25 years, and annualized 11% plus the dividend. Public Storage is the largest in the self-storage market with over 3,300 properties in 40 states, 240 million rentable square feet. And folks, if your garage isn't overflowing with junk, your neighbor's probably is, because people just can't help themselves, so there's always going to be a demand for storage. The company is the least levered in the space at 2.5 times debt to EBITDA in its group, which I think is actually too conservative here, and management could boost that growth by using more debt, but it definitely makes it a safer stock. PSA also has the lowest FFO payout ratio, further cementing that dividend has the highest FFO growth rate for the year. Now you pay a little more on that price to FFO multiple for this kind of competitive position, but it's well worth it. We've still got 3 more real estate stocks to highlight, one with AI growth upside and nearly a 6% dividend yield, but I want to share my favorite resource for data and how to analyze these stocks. We're going to be using the National Association of Real Estate Investment Trusts, the NAREIT's website, which is the industry database and a great one-stop for data. There is a lot of info here, but not to overload you, I'm going to focus on the monthly REIT Watch report. Here you're going to find return information for the group as well as by property type, risk measures, and correlations with other assets. Just an excellent place to start for that big picture data, but the best part here is if you scroll down towards the bottom, you can find data for each real estate stock grouped into the property types. Now again, with real estate, that's how you want to think about these, by that property type, because what's good or bad in growth and valuation can be very different across these different types of property. For example, comparing the cash flow growth in office property, forecasted just 2.8% for the group this year against 16% forecasted growth for the healthcare properties, which are having a blowout year, it really tells you nothing. It's like comparing revenue growth for tech stocks versus that of utility companies. What's great in one is totally different from the other. You can find great stocks to buy in either group, but you have to find the best in that group, comparing those against the property type's fundamentals. Within each of these 5 property types we're targeting, I'm going to be narrowing it down to the best stocks by FFO growth, valuation, or that price to FFO ratio, the FFO payout ratio percentage, and the debt to EBITDA. Now these are the core measures you're going to be using here for real estate stocks. Remember, FFO, or that funds from operations, is like the earnings for other stocks. Since real estate companies have so much depreciation they report on their financial statements, you can't use those earnings reported because it's not a good measure of actual cash flow. Now that in turn makes metrics like the price to earnings look ridiculously high, like the 58 times PE ratio on shares of realty income, because that reported earnings is artificially low. But when we adjust earnings by that depreciation charge to get the funds from operations and use that number, we see the stock's price to FFO is a more realistic 13 times. Like any stock analysis though, it's about finding a balance and the best stocks across all these measures. Which stock is not only growing its FFO the fastest, but is also priced cheaply, is paying out less of its FFO as a dividend, so our measure of dividend sustainability there with that FFO payout ratio, and is less risky with that lower debt to EBITDA ratio. Back to our list though, and a longtime favorite in telecom with Crown Castle, ticker CCI, with its 5.9% dividend and growth in the AI theme. With more than 40,000 cell towers and 85,000 miles of fiber optic cable, telecom infrastructure is positioned for the future of data connectivity. Mobile data usage continues to grow, expected up 21% through 2027, and now with AI and smart cities, is driving a premium for these assets. The company has a higher FFO payout ratio than I usually like to see at 81% of the cash flow paid out to cover those dividends, but it's lower than AMT, and the debt to EBITDA leverage looks really good. FFO growth of 15% is the highest in the group and more than twice that of AMT, and investors are paying about the same, around 20 or 22 times FFO, so you get a faster growing stock for the same valuation. Digital Realty, ticker DLR, offers the lowest dividend here at just under 3%, but also one of the best property types. The company is on the edge of one of the biggest trends in artificial intelligence, that infrastructure demand for data centers to train and run AI, along with everything else in our digital lives. DLR is the 7th largest publicly traded real estate investment trust and owns over 300 data centers across the globe. Just over half the revenue is from the U.S. centers, but the company has a foothold on every continent. Exploding demand for data centers, forecast to continue at a 22% annual pace, has driven the vacancy rate down to just 6.5% in 2023 versus 10% just over 4 years ago, and DLR has more than 3,500 megawatts in buildable capacity, an unrivaled land bank for data centers. Here there are only 2 data center REITs publicly traded, and while Equinix offers the higher dividend, I like DLR here for its scale and a longer history. I'm not sure why NAREIT shows a 0 for this FFO payout ratio, but on a $4.88 dividend divided by the $7.07 FFO expected this year, that would be about a 69% payout ratio. It just shows you have to double check this data and calculate it yourself. Both REITs have a similar FFO growth, just over 8%, while DLR is a little less expensive at 20 times price to FFO ratio. I'm going to show you my top real estate stock in the gaming property type, one of the fastest growing segments of the sector next. But if you like the average 6% dividend yield from these 5 stocks, I know you're going to love the cash flow you get from the stocks in the video linked here in the corner. Not only will those 5 stocks put money in your pocket, but they're also some of the safest stocks you can buy. Great during market crashes like we just saw, so check that video out next. With a dividend of 5.5%, VICI Properties, ticker VICI, is a solid pick in the gaming market. The company owns 93 properties across gaming and experiences, including some of the biggest names in Vegas, like Caesars and the Venetian. The company owns properties in 26 states and all triple net leases, which means the tenants pay all the costs. VICI just sits back and collects the rent. Of course, gaming and that recreational travel is going to be hit in a consumer slowdown if we do get a recession, so this is one of the more risky of the group, but it's always going to rebound back with new economic growth. And while VICI edges it out, GLPI is also a close second in gaming. I like the lower FFO payout ratio at 60% for VICI, which means better dividend sustainability and possibly growth versus GLPI, where it pays out a higher 72% of its cash flow to cover that dividend. Valuation is similar here though, around 13 times FFO, and GLPI actually beats on FFO growth, so again, both may be good buys. Check out Baseline with the link below, sign up for free and get a $100 discount, or click on the video to the right to see those dividend stocks that will never let you down. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.